You're listening to The Preferred Way, a retirement podcast brought to you by Preferred Trust Company, the preferred custodian for all alternative investments.
Hi, everyone, and welcome to another edition of The Preferred Way. Today, we are going to be talking about why investors are leaving traditional retirement accounts and moving towards the self-directed world. And my guest today is Carrie Cook. And so we're going to talk today, well, first of all, in full disclosure, so since we are talking about alternative investments, self-directed IRAs, so Carrie does a little moonlighting, as we're going to call
yes.
it.
I think some people call that. I call that a second job.
Second job, yeah. So runs more than one company. We've got the Self-Directed Custodian, Preferred Trust, and another company that offers alternative investments. So this is a great way for us really to talk a little bit about, she has full knowledge, the background about why things are happening today, the way things are happening. So tell us, why are investors leaving the stock market? What is it?
Yeah, I mean, I think a lot of what's going on right now, a lot of us are blaming the economy for everything. And this is true. Like if you look at your 401k plan, or you look at your stocks, bonds, and mutual funds, we've taken a decent hit recently. Will it come back up? Yes. I mean, if you look at a 50-year trend on S&P, it's going to come back up. But it's times like this that I think investors really start to take a really deep dive, especially if you're nearing retirement. You're taking a really deep dive of like, whew, I don't know if I want to feel this way again. And this particular round has been the uncertainty is so much.
Right.
It's so much and it's so overwhelming. So you've got inflation happening. You've got a disruptor that from a governmental perspective right now that is really utilizing the power to maybe position the U.S. differently. Maybe it'll end up being good. Maybe it'll end up being bad. I'm not on either side of that.
Right. It's just the uncertainty of it all.
It's having an impact. Right. It's definitely having the impact on how we as individuals are investing. It is. But that impact started really the last time this happened.
Yeah.
Like 2008 is really where I felt like the evolution started to happen with alternatives. That's where we really saw people coming in drones saying, we want to diversify outside of the market. And they were coming to Ignite Funding saying, I've got to diversify my portfolio. What do you guys offer? How do you offer it? How does it work? And that's where you could really start to see, even historically, look up the numbers. You saw the trend where you had $33 trillion that was in retirement accounts, all in traditional investing. And then it shifted, and now it's half and half. We literally are half in alternatives and half in the market. That 33 trillion has been cut in half. So what that says to me from 2008 to current is that trend continues to grow. And we see it also on the custodial side.
Absolutely.
Because all the custodians are being purchased or acquired by the big boxes. Because they're trying to buy back that market share. They're trying to get that 18 trillion back.
100%.
And meanwhile, you have the forces of individuals saying, no, I want to invest in alternatives. So I think it really goes back to 2008, and it's just continued. But you see blips like we're dealing with right now, where you see a spike where people are interested in investing alternatives even more. So yes, I mean, we all have to diversify. So if you're 20% down in market and you look at your alternatives, and maybe I take this on a personal level at this point, but I can kind of speak to what our investors are feeling as well. I might have lost 20% over here, but I'm making 20% over here. I'm at par where others aren't.
Yeah.
Because I have that nice balance of both traditional investing, which I'm not saying don't do. I'm saying definitely do it, and I've made money doing that. But you also have to look at the alternative side. And that's where I think the trend has gone. And even though they're acquiring the custodians to try to lean them back to the other side, there's this fight going on right now with, no, we don't want that. And so it's interesting. It's super interesting what's going on right now.
Yeah, I think, diversification, that's obviously what we talk about a lot with our clients is making sure they have a diversified portfolio. But I'm not quite sure they always understand what that true diversification means, because you can be diversified throughout your alternative portfolio as well. So just buying one rental property and putting all that money into that one rental property is not the best idea either, probably.
Yeah.
So talk a little bit about that.
Yeah.
Like what options do they have for diversification once they get into the alternative world?
Yeah, it's a great point. And to say that alternatives are not impacted by what's going on would also be a farce. It would not be true.
Right.
I'll give you an example. Let's say you have an individual that is only building industrial buildings. And not that this happens, but they're building it all out of steel. The whole entire building is out of steel, and all of our steel is coming from China, right? There's obviously going to be an impact there. But if you look at traditional investing, you add real estate in, which is the most popular alternative investment, and then you add in maybe digital currency. Okay, well, digital currency is down right now, so what do we do when the market's down? We buy.
Right.
That's just like the human interaction that you will see.
Yep.
So even though your digital currency investments, an alternative, may be down right now, now's the time to buy, because if it goes back up, you want to ride that back up.
Right.
So then you add to that, it's like, okay, some oil and gas. Like, are you investing in mineral rights? Again, could be tied to real estate, but it's a different class. So you keep classifying, just like you do with the stocks, bonds, and mutual funds. There's stocks, there's bonds, and there's mutual funds.
Yep.
With your alternative investments, it's the same thing. You need to diversify within your alternatives.
Yep.
Now, some would say, well, can I just diversify with real estate? You can.
You can, yeah.
You just need to be in different areas, right? Because supply and demand is changing in those areas. The influx of employment changes in certain areas, which increases the demand. Hence the need for supply.
Yep.
So you may be in an area where apartments are desperately needed because there's just not enough housing. And they've got to get the apartments there. And so you may be investing in apartments in one area, and you may be investing in industrial in another, because everybody's leaving California to come to Nevada because the taxes are lower, right? So our industrial footprint is really high right now because it's cheaper. It's cheaper to have a business here. So yes, industrial may be another piece. So when you look at it that way, and it's like, okay, well, is single family needed?
Right.
Have we just built 6 schools in a community and we don't have single family housing around it? Maybe it's a driving factor. So you could have apartments, you could have industrial, and you could have single family in 3 different areas, all in real estate. So it just depends on your comfort level. And with alternatives, they can be scary.
Oh, sure. Yeah.
And I'm not I'll be the first one to sit here and say that, we don't sell at Ignite Funding, we educate about it. Ultimately, the investor decides whether they want to do that or not, but they don't need a self-directed IRA. They don't even know it exists until we talk about it with them.
Right.
They don't realize that they can diversify what they have in the market, pull back on that, and diversify that, pull it out of a Schwab. Maybe they take 20% of their portfolio, liquidate it out of stocks, bonds, and mutual funds, and move it over into a self-directed IRA so they can invest in alternatives. Because the big boxes don't allow that.
They're not going to really. I always get asked that question. Clients want, well, why haven't I heard of this before? I talk to my financial advisor all the time. And he's never mentioned this type of investment before. And well, they don't get paid to. That's not their realm.
They don't.
So yeah, they're not going to be the chance that they'll lose you as a client.
Yeah.
That obviously they don't want to talk to you about those things.
I had a client the other day say this to me. They said, well, why would I want to move my funds from my IRA to a self-directed IRA and pay a fee? I was like, okay, hold on a second. What? Okay. So where is your IRA? So they tell me where their IRA is. And I said, okay, great. Do you have access to a computer right now? Well, yeah, I have access to a computer. Great. Let's go to the computer. Let's pull up your statement. And they pull up their statement. And I said, okay, scroll all the way to the bottom. There was a period of time where they had to put it up top, and then it was the bottom, and there's some controversy back and forth, because they're obviously going to make sure and lobby that the fee is not seen. And they're like, well, my IRA is free.
Yep.
your IRA is not free.
Nobody works for free.
Nobody works
for free.
The reason why it's free is one or two reasons. One, they're disclosing the fee so below the line that you never know it exists. Or two, they're making money off of the investments your IRA is in. So they're already making 2 or 3%, whether they're taking it in a fee or they're taking it and actually purchasing the product for you in your IRA. Either way, you're paying.
Yes.
So then what we did is we analyzed that fee and we looked at, okay, here's a $300 fee at Preferred Trust to take 20% of your portfolio and move it over into a self-directed IRA to invest at Ignite Funding. And so we looked at that and I said, okay, how much do you plan on investing? So they tell me it was $100,000. Okay, $100,000, $300. Well, let me quickly do the math on a 10% return.
Right.
Hello.
Yep.
They quickly were like, oh, okay. So I get it. They get paid on a percentage of what I have invested. Yes. Which is actually higher than my $300 fee at a 10%. You see, it really quickly resonated with them. And they're like, oh, yeah, but they're not going to talk to you about that.
No.
So alternatives, you have to be in control of it. If you go back to your financial advisor or you go back to Schwab, what are they going to say? They're going to say, well, why would you want to pay for something when you can have it free here?
You can't have that.
That is such a crock of crap.
And you
really
can't have
is.
that. You cannot invest in Ignite Funding if you have a traditional IRA at Schwab. It just doesn't work.
It doesn't work.
This does not work.
It does not work.
They are not licensed to hold those kind of assets, just like Preferred Trust is not we're not licensed to hold stocks, bonds, and mutual funds. Two different things, same type of retirement account.
Yes.
And I think that's kind of a misconception too, is that I think they're afraid to move into alternatives because they think there's going to be massive taxation when they move a portion of their account. And, and again, you're losing that insight, if you will, from your financial advisor. That, they're there to give you advice on what stocks, bonds, and mutual funds to invest in. And you kind of take that out of the alternative world.
Yes.
You've got to be able to do your due diligence. But what investors don't really think about is that they're investing in these things in cash outside of their retirement accounts. So now you can do both ways. Like you already know.
You can. Investment sponsors, do you want more investors? Give them a smarter way to invest. Most investors don't realize they can use their retirement funds to invest in your deals. This masterclass shows you how to offer that option with confidence and get the results you're looking for. From education to implementation, it's all right here. Sign up now and show your investors a better path. And the reality, putting on my Preferred Trust hat again from a company partner perspective, and company partners are like an Ignite Funding. They're groups that are raising capital with the intent of, being able to fund their investments.
Right.
Whether
While
it's a
providing
fund,
an alternative asset.
Exactly. So that diversification is there. And I think, something that kind of gets missed in all of that is when you have inflationary periods, people pull back on their cash. And we always hear that terminology, well, cash is king and it's fast and it's this and it's that. And yes,
not when
you're
it's
right.
not.
If you're a sales representative and you're paid on a commission and whatever, you want to get paid a higher amount the next week, then you're probably going to really encourage the cash investment. But if you're looking at a long-term play, you're looking at a way to get a client in for 10 years, not 1 year, but 10 years, self-directed IRAs and retirement accounts is where you should be focusing your attention. Because I've referred to it before as sticky money. That's just exactly what it is. As soon as a client invests with an IRA or retirement account, those funds really are with that alternative investment for years and years and years to come because they're not pulling it out because then there is a penalty if you're below the age of 59 and a half, right? So you're going to have some sort of penalty. I find myself as an alternative, flipping the hat back to Ignite, I find myself as an alternative investment sponsor educating a lot about self-directed IRAs because that sticky capital for long periods of time is what's going to sustain the company when we have inflationary periods, when cash is not king, we find ourselves rolling back into, well, wait a second, we need to start talking to clients outside of just cash. We need to start talking to them about, what's happening with your investments as a whole. It's very interesting to watch those cycles occur.
Well, and I think it's been very clear and evident with Ignite funding. I mean, they've used self-directed IRA funds to really sustain, and be a bulk of the investors that you have, which is huge, because the company partner, the investment sponsor, is benefiting, but so is the retirement account holder, the investor.
The irony of Ignite funding, it kind of goes back to, I talked about 33 and 18 trillion. Mm-hmm. Ignite funding's servicing portfolio is $450 million. That's what we're servicing right now. 200 million of it
is in
IRAs.
That's insane.
And so when you really look at,
it's split, right?
Yeah. I'm the liability of everything pulling out is it's minimized by half. Mm-hmm. And so sustainability wise, if companies are not raising capital by utilizing the vehicle of a self-directed IRA, then they're probably not going to be around when the next cycle happens.
Yeah.
They just won't. And so if they're not utilizing this as a stable means of raising capital, good luck to you.
Yeah.
Good luck to you. And the education, it doesn't take much.
No.
It really doesn't. Honestly, a lot of my reps, you either have a very active salesperson, or I'm sorry, you have a very lazy salesperson.
Because it's only a couple more words.
Yes. And so, but that's okay.
Yeah.
Because the beauty of it is, it doesn't matter. If you hitch your cart to a good self-directed custodian, you can punt to them and let them take care of asking and answering the questions that are necessary.
Right.
You're still building your pipeline.
And for those sales reps that might be worried about, the commissions and moving things very quickly, I think that's what makes Preferred Trust very unique, is that we do move very quickly and very efficiently, because time is money.
Yeah.
Like, not only for the investment sponsor, but for the investor. The longer the investor sits in cash and doesn't get invested, their retirement account isn't building. And that's the whole purpose.
So true.
So you've got to look for the right custodian. You've got to make sure you know time frames, and you've got to make sure you understand, because the last thing you want is for an investor to be sitting in cash. Then it's not going to matter. Then being able to diversify in alternatives, you're not even getting there, because it's just sitting. It's not actually being invested. Yeah. So, making sure you work with the good custodian and your partner. It makes a huge difference. Yeah, and ones that understand the transactions. Obviously, understanding all the different types of alternative transactions, real estate, digital currency, like you mentioned, the oil and gas industry.
Yeah. So many different things they can invest
precious
in.
metals. There's a lot out there. So, do you think this is a long-term play for now that we're seeing alternatives be more than 50% of the investments out there? Do you think this is long-term? Do you see it increasing, continuing to increase?
It kind of depends. And here's the reason why I'm a little bit hesitant to say, yes, I see it increasing, is you and I both know that over the last 3 to 5 years, there has been a massive movement to purchase all self-directed custodians and collapse them into bigger conglomerates.
Yes.
And those conglomerates are primarily stocks, bonds, and mutual funds. And so I have to imagine that pull, that gravity pull that happened over the last couple of years, is either frustrating the heck out of clients, because I think you and I both know how long it takes to process investments at other custodians, or we're about to see a huge influx of clients coming our way purely out of frustration.
Yeah,
right?
For sure.
Because those custodians don't specialize unless they've acquired the entire company, kept it intact, kept the controller of that company,
right?
Really understand the investments. Those companies slowly, through the acquisition, are getting ripped apart. And as they get ripped apart, the clients are becoming incredibly frustrated.
Oh, yeah.
There's a client, we won't name names, that recently has been trying to move assets from one custodian to us. And this client has millions of dollars in assets.
Yep.
And every asset is a struggle because they just don't understand all the different components of those assets that need to be completed. I mean,
getting them on the phone, I've even attempted, and it's, an hour 45 minutes. That's the wait time to actually talk to a representative. And then I know what client you're talking about. I felt so bad for them because when we finally reached someone on the phone, they provided all their information to identify them, and the person on the other side said, "We do not see an account for you." Oh my gosh!
Can you imagine having millions of dollars with Custodian and
being
that
told
to you?
that? No, I cannot. There's something to be said for continuing to be small but mighty.
Yeah.
We've had the opportunity to be bought out. We've had the opportunity to be, big and huge, but really it's the client service and that level of customer service that we pride ourselves in.
Yeah.
I mean, after all, we're not selling an investment, so the service is the most important part, but it's lost in that big wheel.
Yeah. So it'll be interesting to see what happens with that gravitational pull, because at this point, as we're discovering, they've locked them in.
Oh yeah. Mm-hmm. They give them a deadline. They, almost like if you don't do something with your account, you have to stay with
you're
us.
Stuck.
Right, you're stuck, but yet I can't.
But they're not kidding when they say stuck.
Yes.
Because they have
difficult. 30-day
holds on things and so
funds being posted from investments, the return on the investment, the interest earned every month is just sitting. It's sitting in God knows where, but it's not making it to the client's account. So now the client is suffering. The client maybe needs distributions to live off of.
They are.
And they're suffering. It's not fair.
And so what I would say to anybody that's out there, if you are with a self-directed custodian and you cannot get access to a person, a live being, I'm not talking chats and bots and, all that crap, set that aside. This is your retirement account. Yep. This is your funds. This is not something to mess around with. You need to get out of Dodge because either they're going to try to entice you into something different and get out of alternatives, which you might get frustrated and do. Don't do that.
Right.
Look and weigh the odds of having your traditional investments and a nice blend of those alternatives, because if you don't diversify and you're 65 years old and we have another pullback in the market like we do now, I mean, you're not going to working for the next 5 years.
Yeah, you're not going to have that time.
If you add that level of diversification inside of your portfolio and you're 65 and there's a pullback, it's 50%. It's
at least going to be balanced. Yes,
create some balance in there for yourself. Plus, I mean, depending upon the alternatives, they tend to perform better than the market. And that's for another podcast. But they do tend to perform better overall. And so if you do your due diligence and you're really on top of these different opportunities that are available to you in the alternative space, you could really turn that retirement account upside down.
And
really
we've seen it. I mean, we've seen it. A lot of investors got in and opened a self-directed IRA when digital currency was just starting, right? And got in, bought Bitcoin when it was low, $3,000 a unit. And now it's up today, I think it's at $97,000 a unit. Oh my gosh, we have made millionaires out of people. Or they've made it out of themselves because they've chosen the right time, as you mentioned earlier. Buy when it's low, sell when it's high. But you also have to be patient.
You do.
We saw some of those same investors, unfortunately, they might have bought when it's a little bit higher, and then when it took a dip, they freaked out and left the market. I mean, you have to be strategic. You definitely have to pay attention. Alternatives are a great investment, but you've got to keep your pulse on what's going on.
For sure. Or be working with groups that are.
Yes. Yeah.
You really have to vet out who you're investing with.
I think communication is key too. I think finding investment sponsors that we had a client the other day, we were trying to get a status update on their investment, and they said, you know what? They said, this was just, I made a mistake. The investment sponsor isn't communicative. I haven't heard anything from them. I don't have anywhere to log in. I don't know what's going on. And so I think it's important to really ask those questions of the investment sponsor and be able to say, hey, do you have somewhere where I can access my account and see what's going on? How do I reach a client service agent? And that's one of the things that, you know, obviously we love about Ignite Funding and a lot of those other alternative sponsors out there is the level of communication they have. We want the sponsors that we work with to have the same level of communication that we have.
True.
You know,
so true.
So a lot of research. Do your due diligence for sure.
Absolutely.
Anything else you want to mention about the alternative space that you think is important for our viewers today? If they're considering getting into a self-directed IRA or they're considering making an alternative investment,
I would say the one thing I would say to everybody is if somebody tells you can't do something, chances are you can.
Yeah.
That's right.
Yeah.
If somebody is trying to persuade you against diversification within your portfolio, take a step back.
Yeah.
Take a step back and decide for yourself what's right for you.
Definitely.
Just do that. Don't take that advice of a third party, a company, your friend, your spouse. Like, fight it out a little bit and make sure that you're diversifying your portfolio.
Well, and that's a good point. There are a lot of registered investment advisors out there that are actually today, they are enveloping alternatives underneath what they talk to their clients about. So a good registered...
They have to.
Yeah.
Who wants to pick up the phone and be like, it's down by 30%?
Right.
They're not picking up their phone saying
that.
They're picking up their phone saying, we have some other options now we'd like you to consider because we've been working with this group for a number of years. Here's what we've discovered. Yep. We've been able to balance portfolios. They are thinking differently now.
They are, and they're out there. So there are those advisors out there that are opening that up, and I think that's huge. Yeah. So have those conversations with them.
Absolutely,
sure.
Absolutely.
Yeah.
If somebody says you can't, you can.
You can.
You can.
You can. And then give Preferred Trust a call because we'll explain it. We'll give you all the education that you need to know about alternative investments. That's what we specialize in.
Perfect.
So, well, thanks so much, Carrie, for joining us today.
Absolutely.
Thank you all. And we'll see you on another edition of The Preferred Way.
Thanks for joining us for another episode where retirement savers meet alternative investments. Can't wait for the next episode to learn more? Visit our website at preferredtrustcompany.com.